Let me cut straight through the noise. Australian dollar to US dollar is up 0.25% in the last hour. Traders are slapping the buy button because Australia just printed a monster jobs number. But here's what they're missing. The weekly chart is a strong sell, the daily trend is a strong sell, and this little pop is running straight into a brick wall of resistance that has been building for 3 weeks. Right now we are sitting exactly at the trapdoor. There is one danger zone and one hidden opportunity in this pair right now. I'll show you both. Stay to the end because I'm giving you 3 exact levels you can trade today, complete with stops and invalidation conditions that the herd will never see coming. My session bias right here is simple. We fade this rally. The Australian dollar just got a headline boost, but the structure is screaming sell the rip. We are in a fading environment, not a trending long. The price is hovering at 0.6919, barely above the daily pivot of 0.6902, and I can already see the bearish momentum reloading. The single level that flips this entire bias is 0.6965. Write this number down. If we get a 4-hour candle close above 0.6965, the whole bearish structure resets, stops get run, and we pivot to a trend following long. Until then, any bid is a gift for sellers. I want you to interact right now. Type that number in the comments, 0.6965, and I'll know you're actually serious about trading this session. Now here is the micro insight that matters. The herd is positioned long. The narrative is RBA hike in July is back on, by Aussie. Retail and even some fast money desks are piling in off this jobs print, thinking the path of least resistance is higher. But look at the bond market. The 2-year yield spread hasn't ripped enough to confirm a sustained shift, and the weekly trend is still heavy. When you have a crowd leaning long into a strong sell structure, you get a liquidity vacuum just above current prices. That's where we sell into the trap. Let's walk the charts exactly as I see them, from the weekly down to the 60-minute, because the alignment here is rare and lethal. Start with the weekly. The week opens with a strong sell signal, and that's not a gentle nudge. It's backed by an ADX reading of 58. That's trend accelerator territory. When ADX is above 50 and rising, you don't fight the trend with a conviction long. You look for exhaustion to re-enter short. The weekly moving averages are stacked bearishly. The 20-week MA is way up at 0.7027, the 50-week is 0.7074, and the 100-week is 0.7023, all sloping down and acting as overhead supply. The 200-week MA sits at 0.6896, which is exactly where price found a bounce this week. That 200-week anchor is the floor that's holding for now, but we are testing it again. And that test is dangerous because it's a weekly support that's being probed with weak hands buying the jobs news. Drop to the daily chart and you see the same picture, only sharper. Daily trend is a strong sell. Price is trading below every major daily moving average I respect. The 20-day MA is at 0.7027, the 50-day at 0.7074, both falling like a ceiling. The 200-day MA is 0.6896. And we are literally playing ping-pong just above it. Yesterday's candle was ugly. Today's bounce is tiny relative to the bearish momentum that's been grinding this pair lower. MACD on the daily is still deep in negative territory, printing minus 0.005, with the signal line holding below the histogram, no bullish crossover anywhere in sight. RSI on the daily is at 31.2, just coming out of oversold, which is exactly where bear market rallies spark and die. Here's what most traders miss. Flip to the 4-hour chart. You see a strong sell trend here too, but there's a negative divergence hiding in the momentum oscillators. While price made a slightly higher low this morning, the stochastic and MACD histogram are printing lower highs. That's exhaustion disguised as a bounce. The 4-hour ADX is still above 40, so the trend is intact. The bounce is a correction within a downtrend. The 20-period MA on the 4H is sloping down at 0.6943, and that level lines up almost perfectly with our daily R2 resistance at 0.6945. That cluster is going to be a magnet for shorts. The 60-minute chart, for the scalpers watching, is showing a temporary strong buy signal, but it's wedged between the 0.6902 pivot and the first resistance at 0.6922. That 22 pip zone is a scalper's battleground, not a swing trader's entry. Now let's put exact numbers on support and resistance, because that's what turns analysis into a trade. S1 support is 0.6879, S2 is 0.6859, and S3 is 0.6836. Resistance R1 is 0.6922. We are kissing that right now. R2 is 0.6945, and R3 is 0.6965. The pivot point is 0.6902. If the price breaks below 0.6902 on a 15-minute close, the intraday structure flips bearish and the trap is confirmed. And I'm cross-linking here because this is where the macro threads together. Gold is chopping sideways as real yields wobble, but the Aussie is tightly correlated to iron ore and China's demand pulse. Iron ore futures are soft today, and the yuan is weakening, which means the risk barometer that the Aussie represents is flashing caution. The equity markets are giving us a fragile risk-on bid, but nothing that can overpower a 58 ADX downtrend. So what changed in the last 24 hours? Australia's May employment report smashed estimates. Employment change rebounded to 55,000 versus an expected 20,000, and the participation rate held firm. That instantly revived RBA rate hike bets for July, and the knee-jerk reaction was a 25 pip spike in Australian dollar to US dollar. But here's why that move is already fading. The market was pricing only a 40% probability of a July hike before the data. Now it's maybe 55%. That's not a conviction shift. It's a probability quiver. More importantly, the RBA's own rhetoric has been cautious. They've been clear that one data point doesn't pivot policy. So what's priced in is a token repricing, not a trend change. And the Australian dollar crosses are reflecting that. AUD NZD is heavy. Australian dollar to Japanese yen is stuck below resistance. The yield differential between Australian 10-year bonds and US Treasuries hasn't broken its recent downtrend. That's the real driver for Australian dollar to US dollar, and it's still pointing lower. Now let's weave the cross-asset narrative. The Aussie is the Asia risk proxy. When global risk appetite cracks, the Aussie gets sold first. Look at the S&P 500 futures. Choppy, gamma-pinned, VIX term structure nervous. Bitcoin is stalling below its 200-day MA. These are not conditions for a sustained Australian dollar rally. China's PMI numbers are softening, and the iron ore price is sliding off its recent highs. The correlation between Australian dollar to US dollar and the daily iron ore futures is 0.74 over the last month. That linkage is screaming caution. If the commodity complex can't catch a bid, the jobs report becomes a one-day wonder. MY 1 to 2 week directional lean is firmly lower, targeting the S3 zone at 0.6836, and if that breaks, 0.6800 and the yearly lows open up. The exact event that invalidates this view is a sustained risk-on melt-up in equities combined with a 4H close above 0.6965. I also want to see what the RBA minutes reveal next week. If they push back against the July hike narrative, the Aussie could collapse through that 200-day MA in one session. Do you think the dollar breaks 105 this week? Comment yes or no below. I'm tracking consensus and I'll give you my DXY read in tomorrow's breakdown. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to lay out 3 precise trade plans, each with an entry trigger, a stop, 2 targets, and a clear invalidation. No ambiguity. And after I give each strategy, I'll put a clean trade card on your screen so you can screenshot it and execute without thinking. Let's go. Strategy 1. The sniper. Conservative. This is the one for those who want to wait for the highest probability confirmation before committing capital. We are selling into the resistance cluster. The trigger is a rally to 0.6945. Which is the daily R2 level and lines up with the 4H20 MA. But I'm not blindly entering at that number. I want a 1-hour bearish engulfing candle that closes back below 0.6940. That closure confirms that the selling pressure is real. Stop loss goes above 0.6965 at 0.6970, just above the structural invalidation and the R3 pivot. Target 1 is 0.6900 at the pivot point. Target 2 is 0.6870 just below S1. That gives a risk-reward ratio of roughly 1 minute and 2.7 seconds. The setup is void if any 4H candle closes above 0.6965. The sniper, conservative, entry, 0.6945, 1H bearish engulfing close below 0.6940, stop loss, 0.6970 take profit 1, 0.6900 take profit 2, 0.6870 risk, reward, 1:2.7 are invalidation. Void if 4H close above 0.6965 strategy 2. The active trader, the standard play for those who want to catch the resumption of the trend without waiting for a deep pullback. This one triggers on a breakdown of the pivot. We are looking for a 15-minute close below 0.6898, which is just below the 0.6902 pivot and the psychological 0.6900 handle. That close confirms that the jobs bounce has been absorbed and sellers are back in control. Stop loss goes at 0.6930, above the recent hourly swing high and above the R1. Target 1 is 0.6870. Target 2 is 0.6840, the S3 support extension. Once target 1 is hit, immediately move the stop to break even and let the runner ride with a trailing stop of 15 pips. This setup is void if the price fails to close below 0.6898 in the next 4 hours or spikes back above 0.6922 with volume. Here's the active trader graphic. The active trader, standard, entry, 0.6898, 15-minute close below, stop loss, 0.6930 take profit 1, 0.6870 take profit 2, 0.6840 risk, reward, 1:2.9 are invalidation. Void if price reclaims 0.6922 with volume. Before I give you the third setup, I want you to do something. Type your Australian dollar to US dollar range for tomorrow in the comments right now. Give me your high and low, and I'll see who's aligned with the institutional flow. Drop it in the chat. Strategy 3. The aggressor, high risk, high reward. This is for the maniacs who want to scalp the counter-trend bounce on the 1-hour chart. The 60-minute is flashing strong buy, and if you're nimble, you can ride the liquidity grab higher before the dump. The entry is a dip to 0.6900 right after a spike. Wait for a 5-minute bullish hammer or a bullish engulfing candle that closes above 0.6905. Enter long on that 5-minute close. Stop loss is tight at 0.6885, just below the Asian session low and below S1. Target 1 is 0.6930. Target 2 is 0.6945 at the R2. This is a quick scalp with a risk reward of roughly 1 minute and 1.8 seconds. Invalidation is a 5-minute close below 0.6895. Only for those who can lose small and manage risk aggressively. If the 1-hour trend flips back to sell while you're in, kill it instantly. Aggressor trade card on screen now. The aggressor, high risk, entry, 0.6905, 5 minutes bullish engulfing close after pullback to 0.6900, stop loss, 0.6885 take profit 1, 0.6930 take profit 2, 0.6945 risk, reward, 1:1.8 are invalidation. Void if 5-minute close below 0.6895. Let's get one thing straight. Never risk more than 1% to 2% of your account on any single trade. I don't care how good this setup looks. If the RBA minutes drop unexpectedly or China throws a policy bomb, you need to be protected. No positions through high-impact news events. Stops are non-negotiable. Hard stops in the market, not mental ones. This is how you survive to trade the next big move. The 0.6965 level is your lifeline. Respect it. The single most critical level for the next session is 0.6965. A break above that and the bearish narrative is dead. Below it, every pop is a gift to reload shorts. Tomorrow, all eyes shift to the RBA governor's speech and the US core PCE print. Either one could be the explosive catalyst that pushes Australian dollar to US dollar through the 200-day MA and opens a freefall. I'll break down the exact scenario before it happens. If you want the full institutional view on Bitcoin and the S&P 500 divergence, that video is live now. Tap the end screen and I'll walk you through the liquidity grab that just swept the range lows. Smash like if this gave you a clear, executable plan. Subscribe, hit the bell, and I'll see you in the next one. This is how volatility turns into profit.